Peter, I know you've been pretty cautious on the markets. Where do you stand on the recession fears that really cranked into high gear last week with the inversion of the yield curve?
Right. Well, my concern really started with global growth slowing, sort of towards the end of last year. We all seem to have sort of forgotten that there was a lot of talk of recession towards the end of last year. And I actually thought at that point in time it was a bit early. I thought those fears were overblown. But as the fundamentals have continued to deteriorate globally, really the sole bright spot here in the U.S. is the consumer. And that's really still a result of relatively favorable financial conditions. Lending standards are tightening a little bit, but as rates have come in, obviously, that's been a boon to the consumer. So I am a bit concerned that we have a recession on the horizon for 2020, but we really need to start to see the consumer weaken a bit more than we've seen thus far, albeit I do think it is a bit of fait accompli for 2020 that we will be in recession.
Yeah, Peter, some say the sell-off is overdone. Some say you should wait until September to jump back in, let some of the dust clear, see what happens with the tariffs on the 1st, Jackson Hole, Fed meeting coming up. What do you think?
Well, look, I think Chairman Powell is going to be cautious in Jackson Hole with what he says. I think it's actually a very important communication, particularly because it's an intermeeting communication, and he did have 2 dissents, and Rosengren came out earlier today with a bit of a hawkish tone. So I think Chairman Powell is going to kind of try to hit a single or a double, not say too much, not say too little. The market's expecting quite a bit, and frankly, the rally that we've seen over the past 2 sessions, I think, is wholly based on this idea that we're going to get policy stimulus out of Europe, both in the form of monetary policy stimulus as well as fiscal policy stimulus, which the Germans seem to be supporting, and that, frankly, the Fed is going to be more aggressive than it is so far communicated. So I don't think we see much out of Chairman Powell, and I do think the market will be disappointed through the end of the week with the minutes and with Chairman Powell's communication at Jackson Hole.
You agree with that, Tobias? The market's going to be disappointed, expecting too much out of Jackson Hole?
I'm not sure the market's expecting that much. I think they're expecting to say, hey, we're still data dependent, and if the data gets worse, we'll react appropriately.
You don't think he's going to come out and say, don't worry, we got your back?
I don't know if he's going to use that kind of terminology.
No, he's not going to use that.
But he's going to say, yeah, if
mean?
things deteriorate, the Fed is here to provide support for the economy. But that's consistent with anything any Fed chair would say.
All he has to do is get rid of mid-cycle adjustment, talk about an easing cycle, talk about...
Yeah.
But he's not. He shouldn't.
Downside risk.
Forget about what Wall Street wants. A Fed chairman shouldn't be sitting there saying, I'll get rid of, I won't talk about easing cycles, I'll put in the words you want to hear as opposed to what I'm supposed to be doing.
Well, the words he said before were confusing to people.
Yeah, I get that, but most of the data we're looking at is mid-cycle correction, not recessionary. Even the word...
Why do you say that? Because others don't agree with you.
I know. Because I'd have to see further deterioration in credit conditions. We haven't seen that. That usually leads it. I'd have to see even small business tell me credit is harder to get by, and they're not saying that. I'd have to see ISM new orders in the low 40s to believe that. I'm an old industrials analyst. I lived this. I would have to watch capital spending really collapse. We just did a study looking at 700-plus companies on capital spending. They're still saying growth. A little less than they were saying before, but they're still saying growth. So it's not kind of like we're rolling off the edge. And, I disagree with the overseas perspective. 75% of S&P 500 sales are North American derived, and another 10% of sales are non-cyclical international, like food, beverage, tobacco, drugs. So we're not wagging, we're wagging the tail of the world, not the other way around.
Peter, you want to push back?
Yeah, no, I would say, actually, I don't think that revenue attribution number is correct. I think it's closer to 55.
I've done every single
60,
company. This is what I do for a living.
But more,
With all due respect.
understand, but moreover, the S&P 500 in and of itself, I agree with you. It's only a piece of the equation, but consumer conditions are actually starting to deteriorate a bit. Lending standards are starting to tighten. And by the time, frankly, we see all those conditions emerge in the way that you've described, we're already in recession. What one needs to do is look at earlier cycle indicators like the yield curve. Typically, financial conditions are a much better indicator of future recessionary conditions than when the data is already screaming it. By that time, it's too late, and the market is typically down double digits.